How does a company keep expanding its profits when the market for its most important product is no longer growing the way it once did? For years, the answer seemed obvious. Apple was the iPhone company. The iPhone generated more revenue than any other product in its portfolio, shaped the company's brand, and became the center of its relationship with customers around the world. That created a simple assumption. If Apple wanted to keep growing, it needed to keep selling more iPhones. But the smartphone market had already begun to mature. Most consumers who wanted a smartphone already owned one. Improvements between generations became less dramatic. People started keeping their devices for longer. The explosive growth that had defined the early years of the industry was becoming harder to repeat. That should have created a serious limit for Apple. A company that depends on a single hardware product usually faces a difficult economic cycle. It sells the device, collects most of the revenue at the moment of purchase, and then waits for the customer to return several years later. Growth depends on attracting new buyers, during upgrade cycles, raising prices, or launching another major product. Yet Apple continued to generate enormous amounts of revenue and profit, even as the smartphone market became more mature. The reason cannot be explained simply by saying that Apple sells expensive phones. The iPhone still matters enormously. It remains Apple's largest product category and the main entry point into the company's world. But the economics of Apple no longer end when the customer walks out of a store with a new device. That purchase can be followed by cloud storage, applications, subscriptions, payments, warranties, advertising, digital content, and additional devices. A customer who begins with an iPhone may later buy wireless earphones, a watch, a tablet, or a computer, all connected through the same account and designed to work together. This changes the nature of the relationship. Apple is no longer dealing with a customer only at the moment of a hardware sale. It can continue serving that customer across many products, many transactions, and many years. The important distinction is between selling more units and creating more value from the installed base that already exists. A traditional hardware company asks how many new devices it can sell this year. Apple can ask a different question. How much economic value can be created after the first device has already been sold? That question becomes more important as the smartphone market slows. If Apple's future depended entirely on shipping an ever larger number of iPhones, its growth would eventually run into the limits of the market. But if the iPhone is only the beginning of a much longer commercial relationship, then the number of phones sold is no longer the only measure that matters. The real question is not whether Apple can keep selling more smartphones forever. It is how Apple built a profit engine that can keep expanding even when it does not. To understand how this became possible, it is important to separate two very different ways of looking at Apple. The first is the company that sells products. The second is the company that manages relationships. For most of its history, Apple was evaluated primarily through the success of its hardware. Every major product launch was treated as a test of whether the company could convince millions of people to buy another device. Revenue rose when customers upgraded. Revenue slowed when upgrade cycles became longer. That model was extraordinarily successful because the products themselves were exceptionally profitable. The iPhone became the center of Apple's business, accounting for approximately $209.6 billion United States dollars of revenue in fiscal year 2025, or roughly half of the company's total revenue of $416.2 billion United States dollars, according to Apple's annual report. The iPhone remained the single largest business inside Apple by a wide margin. However, another business was quietly becoming much larger than many people realized. Apple's services segment generated approximately $109.2 billion United States dollars in fiscal year 2025. This category includes the App Store, Apple Music, Apple Television Plus, iCloud, AppleCare advertising, payment services licensing, and other digital offerings that continue generating revenue long after a customer purchases a device. At first glance, these may appear to be separate businesses. In reality, they are connected by the same customer. Apple never designed its products to exist in isolation. Every device is linked through the same Apple account, synchronized through the same operating systems, and connected by the same software ecosystem. An iPhone can unlock a Mac. AirPods automatically switch between devices. An Apple Watch depends on an iPhone. Photos, messages, passwords, Subscriptions and payment information move seamlessly across products. Each additional device does more than create another sale. It makes the entire ecosystem more useful. That creates a subtle but important economic shift. Instead of measuring success only by how many devices leave the factory, Apple can increase the value created after those devices are already in customers' hands. This is why products such as Apple Watch and AirPods deserve more attention than their individual revenue figures might suggest. They are not simply accessories designed to increase hardware sales. They strengthen the connections between products, encourage customers to spend more time inside Apple's ecosystem, and make switching to another platform increasingly inconvenient. The same principle applies to services. A customer who stores photographs in iCloud, purchases applications through the App Store, subscribes to Apple Music, and uses Apple Pay is not making one transaction. That customer is participating in an ongoing commercial relationship. As Apple continued expanding its installed base of active devices, each new customer represented more than the value of a single hardware purchase. Every additional user created opportunities for future transactions that could unfold over many years rather than during a single product cycle. This gradual evolution did not replace Apple's hardware business. Instead, it gave the hardware a second role. The iPhone was no longer only a product that generated revenue when it was sold. It also became the gateway through which Apple could build a much longer and far more valuable economic relationship with every customer who entered its ecosystem. The financial consequences of that shift would eventually become impossible to ignore. The real transformation became visible when Apple's financial results began telling a different story from the one many investors were still following. The company was no longer generating value only by convincing people to buy another iPhone. It was generating more value from people who already owned one. That difference may sound subtle, but financially it changes everything. In fiscal year 2025, Apple's services business generated approximately $109.2 billion United States dollars in revenue, an increase of 14% compared with the previous year, according to the company's annual report. During the same period, iPhone revenue grew by approximately 4%. The contrast matters because growth rates alone do not explain Apple's expanding profitability. Profit margins do. Apple reports gross margins separately for products and services. In fiscal year 2025, products achieved a gross margin of approximately 36.8%. Services reached approximately 75.4%. In other words, every additional dollar generated by services produced far more gross profit than an additional dollar generated by hardware. The impact becomes even clearer when those numbers are viewed together. Although services represented only about 1/4 of Apple's total revenue, it generated more than 82 billion United States dollars in gross profit. That was roughly 42% of Apple's total gross profit for the year. This was not simply another successful business unit. It fundamentally changed the economics of the entire company. The reason lies in how these revenues are created. When Apple sells an iPhone, the transaction largely happens once. Manufacturing, logistics, retail operations, and component costs are all concentrated around that sale. Many digital services operate differently. Once the underlying platform, infrastructure, and ecosystem are established, serving additional users often requires significantly lower incremental costs than manufacturing another physical device. That allows a much larger share of each additional dollar of revenue to become gross profit. More importantly, these revenues do not depend on convincing customers to purchase an entirely new product every year. An existing customer can continue paying for cloud storage, subscribe to digital services, purchase applications, make payments through Apple's platforms, renew protection plans, or consume digital content without replacing the original device. At the same time, Apple's installed base continued expanding. The company reported a record number of active devices across its ecosystem, creating an ever larger foundation upon which those recurring transactions could occur. This created a powerful economic cycle. Every new iPhone sale increased the installed base. A larger installed base created more opportunities for services. Higher services revenue generated disproportionately higher gross profit. That additional profitability gave Apple greater financial flexibility to invest in software silicon retail, developer tools, artificial intelligence, and new hardware experiences, making the ecosystem even more attractive to future customers. The remarkable aspect of this strategy is that it did not require smartphone demand to return to the explosive growth of the early 2010 years. Apple was gradually changing the source of its economic momentum. The company was no longer relying only on finding millions of new customers every year. It was learning how to create more economic value from the customers it had already earned. That distinction reveals something important. The biggest product inside Apple may still generate the largest share of revenue. But that alone does not explain where the company's growing profitability is really coming from. At this point, it becomes tempting to reach a simple conclusion. Services are growing faster. Services generate much higher margins. Therefore, services must have become the real business, while the iPhone is becoming less important. The financial evidence does not support that conclusion. Instead, it points towards something much more interesting. Apple did not build a more profitable company by reducing the importance of the iPhone. It built a more profitable company by changing the role the iPhone plays inside its business model. Traditionally, a successful product is evaluated by the revenue and profit generated when it is sold. Apple's strategy extends beyond that moment. The company treats the initial hardware purchase as the beginning of an economic relationship rather than the end of a commercial transaction. That distinction explains why the different parts of Apple's business cannot be analyzed independently. Take the App Store as an example. Without millions of active iPhone users, there would be no large market for developers to target. Without high-quality applications, the iPhone would become less valuable to consumers. Each side strengthens the other. The same logic applies across the ecosystem. AirPods become more useful because they integrate seamlessly with Apple devices. Apple Watch delivers its greatest value when paired with an iPhone. Mac computers benefit from shared applications, synchronized files, and continuity features. Services become more attractive because customers already spend much of their digital lives inside Apple's ecosystem. Every additional connection increases the value of the network surrounding the customer. This is why switching away from Apple often involves much more than replacing a phone. A customer may also need to replace wireless earphones, a smartwatch, cloud storage, purchased applications, payment methods, messaging habits, shared family subscriptions, and years of accumulated digital content. The cost is not measured only in money. It is measured in convenience, familiarity, integration, and time. That makes the ecosystem increasingly resilient. Importantly, none of this means Apple can ignore the quality of its hardware. If the iPhone stopped attracting customers, the entire system would eventually weaken. Fewer new devices would enter the installed base. Fewer customers would join the ecosystem. Over time, services would also lose opportunities for growth. The relationship works in both directions. The hardware feeds the ecosystem. The ecosystem makes the hardware more valuable. Together, they create a reinforcing cycle that is much stronger than either business could create alone. This changes how Apple's most successful product should be understood. Its strategic importance is not limited to the revenue generated when it leaves the factory. Its greater value comes from opening the door to years of future interactions across software, digital services, connected devices, and recurring transactions. Viewed from that perspective, the iPhone is no longer simply Apple's largest product. It is the primary distribution channel for an entire economic system. That is why focusing only on hardware sales misses the larger picture. The most successful product inside Apple is not valuable solely because it sells in extraordinary numbers. It is valuable because it enables a much larger engine to keep creating value long after the original purchase has already taken place. Seen this way, Apple's financial performance is no longer a story about escaping the limits of the smartphone market. It is a story about changing what growth means after the market matures. The numbers support that shift. In fiscal year 2025, services generated approximately $109.2 billion United States dollars in revenue. More importantly, Apple's reported gross margin for services reached approximately 75.4%, compared with 36.8% for products. Although services accounted for only about 1/4 of total revenue, it contributed roughly 42% of Apple's gross profit because of its much higher margin. Those figures do not suggest that hardware has become less valuable. They suggest that hardware has become more valuable than its own revenue can reveal. The first sale is only the visible part of Apple's economic model. Everything that follows is where the relationship continues to expand. Every additional service subscription, every application purchased, every cloud storage upgrade, every Apple Watch paired with an iPhone, every AirPods purchase, every payment processed through Apple's ecosystem. Each interaction increases the total economic value created by the original customer. That is why Apple's installed base has become one of its most important strategic assets. The company is no longer measuring success only by how many devices leave the production line each quarter. It is also measuring how much value those devices continue creating after they are already in people's hands. Apple's own financial reporting reflects this evolution. In the first quarter of fiscal year 2026, the company announced another record for services revenue, reaching $30 billion United States dollars. The following quarter, Apple again reported record services revenue. The pattern is consistent with the direction that has been developing for years, rather than a temporary result from a single product cycle. The important point is not that services are replacing the iPhone. The important point is that Apple designed an ecosystem where every successful hardware sale increases the opportunity for future software, digital, and recurring revenue. That changes how Apple's profitability should be interpreted. A company that depends entirely on selling more units eventually confronts the limits of market demand. A company that continuously increases the lifetime value of existing customers can continue expanding even when unit growth becomes much slower. That is exactly what Apple's ecosystem makes possible. The iPhone remains the gateway. The surrounding ecosystem multiplies the value of every customer who enters through that gateway. The result is a business that does not need every year to produce another explosive increase in smartphone sales in order to keep strengthening its economics. Perhaps that is the most revealing way to understand Apple today. The company's greatest strategic asset is not simply the product that sells the most units or generates the most revenue. It is the system that allows one successful product to keep creating economic value long after the original transaction is over. Once that becomes clear, the slowing growth of the smartphone market no longer looks like the ceiling on Apple's future. It looks more like the starting point for understanding why the company's profit engine extends far beyond the iPhone itself.